Okay, thanks for joining me today. My name is Matt Simpson, do the market analysis at ThinkMarkets. So indicators explained. What we're trying to do here is give you a bit of a primer, and it's not really going to be a mathematical breakdown of how they are created or a sales pitch for why they're fantastic. Trying to give you guys some basic tools here to try and figure out yourselves whether you should be using a certain tool under a certain market condition or not, because that really is the key here. I'm sure when you go on various forums and see lots of gizmos and flashing lights, it looks very appealing, and nobody's going to tell you that an indicator doesn't work most of the times, or they're not very good. I would go as far to say that maybe 95% therearound of indicator can pretty much be grouped into one of two things, which is are they trending or non-trending. But let's go through. What we're doing is going through some slides, basic theory. Happy to answer questions as we go along, and then as always we'll end up on live charts and just put some of that into practice, and may find some things, may not, hopefully. So typically what you'll see, or what I've seen over the years, when you've got sort of newer traders, and we've all been there, you open up, you've never traded before, you're learning all this stuff, and you just see a huge list of indicators and you think, wow, that's amazing, can't wait to get stuck into this and try everything out. And it's quite overwhelming. There's lots of flashing lights, lots of markets you don't really understand, lots of things to do. It doesn't necessarily help you initially, and then very quickly, I think we've all done this as well, this ends up to your chart and you don't know what's up and down. You're no longer looking at price, which I would say is, I'm a chartist, I'm a little bit biased here, I would say the price is the most important thing on the chart. But I've done a lot of coaching over the years, and the amount of times when I've been sat there and watching what they're looking at on the screen, a lot of the time they're not looking at the chart, they're looking at their indicators at the bottom and trying to figure out in their head when can they get in next. And again, indicators, they're great, but they're like any tool. In the wrong hands, they can be pretty dangerous as well. So we need to use common sense at all times, and indicators are really no different. And trend analysis, you can't escape it. If you can do basic trend analysis, and it's going to really, really help you. Little tip I'd give you, if you spend, let's say, more than 10 seconds trying to figure out if there's a trend or not, really, when you start doing a lot of time, you should know pretty much instantly if it's in a classic trend or not. Chances are it's probably not in a trend, or you're a bit confused, and you should probably go find an easier. And for example is, if we spend the next half an hour debating if this is in a trend or not, and there's going to be trends within this area, but overall, if you look at if we say current price is here, you look left and it's not really traveled anywhere, well, it's not really in a trend, it's zigzagging around the place and it doesn't know what's going on. If you higher high, higher low, that's a trend definition, and you can see straight away, if you imagine there's nothing on the chart to the right of this, you're just pointing up, then we can make the assumption we're in a trend, and just doing that quick analysis, you've already got yourself an advantage that there may be some indicators are more suitable than others. So really, is it pointing up, going sideways, or going down? That should be, in my opinion, one of the first things you do when you look at a chart on any time frame, maybe even before you look at the instrument. And just to it will sound obvious, but indicators indicate that there's nothing magic about them. There's nothing that's 100% right all the time in these things, and they're just giving potential signals. And anybody who has designed an indicator over the years or decades, they're trying to, I would say, they're trying to make things better than they are. And again, what you will tend to find is that you can't have everything. So whilst you'll improve some conditions of maybe price action, you also lose something somewhere else. It's like squashing a balloon, you can't quite sort that out. So, but what can they do? They're very good for rules-based systems. So if you're doing an EA, if you're doing robots or EAs, they're clearly a huge backbone to programmed or automated trading. They can help you with market conditions, and if you're a manual trader like myself, they can help you stay on the track essentially as well. But again, don't do that first slide where you've got your entire screen filled up with lots and lots of stuff. It's not necessarily better. And they're very good for trade entry signals, trade exit signals. They can help identify trends. Divergences, we'll cover those as well. But the divergence, in my opinion, isn't a reason to short a falling market or short a rising market or buy a falling one. It's a tendency of an indicator that when trends turn, they'll give warnings of a turning point. But if you look at chart long enough, you realise there's many failed warnings. Every single trend is essentially a series of failed turning points, and then at some point there will be that turning. So we'll be doing a separate webinar on divergence trading, because that is a whole art within itself. But they can help the market conditions and essentially rule-based trading. They can fail, just remember that. Nothing is 100%, and it's just an amalgamation of data essentially. And I'd argue that the more you have on the screen, especially when you're starting out, it's not necessarily a good thing to try and master everything at once. And I would urge those to literally start with a naked price chart and get the nuances of price, and then start to realize how they counteract with indicators. So if you do that too much, they can actually leave you vulnerable. If you've got a huge belief in these indicators you've chosen, yet you keep losing money, or you have a good run and you have a bad run, well, chances are what you'll end up doing is to try swapping indicators or swapping markets, and that's not necessarily what you want to prove if you're a good trader or not. Get the indicators wrong, get too many or too few signals as well. And again, there's no magic length. You'll see lots of people saying their favorite indicator settings, or like the RSI 14 is very popular. I think the best quote I heard, or I forget where I heard it, but they were saying it doesn't really matter what setting you use, it's what your eyes get used to. So you've got price plus data manipulation is what an indicator is, and this is my hierarchy. Price is the most important thing on a chart, volume secondary, and then the third is indicator. A lot of people will disagree with me there, but this is what I think, and you're free to disagree with me. Whilst we're on volume, we won't do on this too long, but there are differences in volume. So those who maybe come from a stock background, you'll have maybe access to an exchange feed, and you've got volume and tick volume, and volume is looking at the real monetary amount. This here is actually a CFD, and it's tick volume at the bottom. If you compare that to actual volume, volume is looking at the amount of money traded in per bar, whereas tick volume is the amount of times a price was traded. Now, a lot of the times they give very, very similar signals, and it's okay on Forex more so, I'd say, but you know, there's a big difference between buying 1 million shares at a price or buying $1 million worth of shares at a price. So keep that in mind. And this is more, I would say, that if you're trading CFDs, and volume is part of the analysis, I would urge you to try and get some sort of data that gives you official exchange data, and use that over the tick data. Now, if you go to Forex, here is the Australian dollar. I've got two different programs trying to match it up, and you've got Australian dollar on the ThinkMarkets MT4 platform. And then when you compare that to another software provider, where they amalgamate lots of different feeds, there's not a huge difference really. And I always go as far to say that actual fact, I'm perfectly happy using tick volume as part of my analysis. Yes, there'll be some differences sometimes, but that's exactly the same as if you compare one broker to another. But again, really the most important thing, in my opinion, is this thing up here, and you don't really want to spending too much time over analyzing what these things down here are saying. So again, it's about applying indicators to suitable conditions. And this is a very, very rough framework. I mean, I don't want to make it too in-depth, but you know, is the market trending or not? Is it up or down? Is it relevant at this stage? And this is a very broad way of grouping it, but generally speaking, make the assumption that if you're looking at trend in markets, moving averages tend to be a bit more helpful. I say tend to be because if you master moving averages, well, there's some things you can do where they're actually very good to use in sideways markets as well, but that's going to a different level for this presentation. If you've got sideways markets, momentum indicators or oscillators tend to be more successful at what they're trying to do, and we're talking about those classic, everybody loves the overbought, oversold indicators. They make you feel safe. Trouble is you'll see that if you've got a strong trend and you've got lots of momentum into a move, what will happen is a market will stay incredibly overbought in a bullish move or incredibly oversold. Now, if you start trying to do the overbought, oversold signals on that and you're fading a trend, well, you've forgotten the most basic thing here. Look at the trend. Is it trending? Is it not? And that's probably one of the best one thing to take away from this is how you would divide those. So moving averages are generally a lot better to use on trends and multi-time frame analysis. And if you can't, stick some oscillators on and some good signals hopefully come out. Keeping in mind at any stage, a trend can turn into a sideways, and the sideways can turn into reversal or back to a trend. Standard deviation I've put in the middle because in actual fact, standard deviation reverting back to the mean would typically be more not successful, so that's the wrong word. Initially look more useful in a sideways market where you've got sideways oscillations, but at the same time there's things you can do with trends as well, so there's a bit of a mixture here. There's no hard and fast rules, but here's how I look at things. So if you look at examples of momentum, I'll go back to that quote that pick one and it's what your eyes get used to, essentially. And there's some people who swear MACD is the best indicator, and there's some that swear by RSI. It doesn't matter. You need to do this for yourself. You need to decide what you are comfortable using with, what your eyes and your brain get used to doing, and experimenting. Now, I've done lots of experimenting with period times and stuff, and if you really want to get into the analysis of it, then there's some great things you can do with cycles and changing the length and using multiple indicators, but we're not here to talk about analysis, we're here to talk about trading, and hopefully you making fewer mistakes or not being taken down this path of magic indicators, so forth. But I think we can kind of agree that when you look at whether it's momentum, RSI or stochastics, yes, there are differences between what's going on, but if you were to overlay them with each other, a lot of the time they're showing very, very similar things. One might be faster than the other, but they're trying to show either overbought or oversold. And really, a lot of the time you're saying if price is going up, is momentum following it or not? If not, then it's losing momentum. When you're doing this long enough, you don't actually need these. You can see it in the price, but we'll cover that more on the price charts as well. And again, you can pick up a lot from just looking at a naked chart and getting a lot more behind it. And if you could master that, or at least try to, and then start bringing indicators in, I reckon you'll be a much more rounded trader and analyst as well. Okay, so the stochastic oscillator. As I said before, classic overbought is usually you'll find indicators with, it might be 80, might be 70, and the theory is that when it reaches this level, it's overbought, and classically you maybe look to sell. Conversely, if it moves far down to the oversold level, you might look for bullish opportunities. Really what you want to be doing if you're looking for those sorts of strategies is, again, price is probably the fastest thing on the chart here. Therefore, indicators follow price, not the other way around. So if you've got a signal that's saying, okay, I'm overbought and now it's starting to curl lower, again, classic trend analysis, has the price broken a price swing low? Has it started to do so? And then what I'd say, to take it a step further, is once you've got price moving lower, you'll see what I mean if you try this for yourself. If you tried and traded every single one of these turning points and then you try and get a decent reward to risk, you find by the time the signal gives it, you can't get a decent reward to risk. So really what you might want to consider doing is when you get, say, a sell signal from something like stochastics and price starts moving down, go to a lower time frame and then do it that way. We've made the assumption that the trend is going to continue, and then you use a lower time frame to trade in the direction of that signal. If you actually look at what's happening here, there's different ways of interpreting what's happening. Some would say that you've got to wait for the breakout to come into and out of the overbought level and then prices to go. But if you actually spend the time to get like a crosshair and look at what happens, you miss several bars sometimes of the move. And when prices break out, they can move really quickly. So just be aware of that. There'll be lots of claims that indicators are predictive. I argue they're not. They're about as predictive as I am, which is I'm not. But they are helping you keep on a certain path, essentially. Now again, this is what I said. Notice here, classic trend analysis, lower low, lower high, lower low, lower high, that's a trend. And as you would expect, it stays in oversold. So if you were using it's at 20, I'm going to start buying, that will be well, several painful trades, I would imagine. Depends on how keen you are. And the same, the reason this is happening is because you've got 14 periods. So if you see the number on this one is saying I'm taking 14 periods worth of data, doing my magic to give you this wonderful indicator because price isn't good enough. Basically what happened is if you've got 14 periods where it's just been going up every single day, there's nowhere else for that indicator to go other than overbought or 100%, depending on how aggressive that would be. So it's a mathematical, it's not even a phenomenon, it's just math. So be wary of that. If you give up your trend analysis and you're just looking at the bottom of that chart, you're going to be whipped into some horrible market conditions that are not favorable to what maybe your strategy is doing. And the same here as well. So in actual fact, if you see prices falling and they're stuck down, that is a bearish signal and is not a reason to buy, in my opinion. And then if you do see this, I'd understand why you go, I've missed the move, and you just watch it go lower, 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 lower. That is where you go to a lower time frame, and then maybe you might consider trading as fading into pullbacks on the lower time frame, knowing that on the higher time frame, stochastic is inverted, overbought, oversold. Again, moving averages, they're a great thing to use to help you with this, and I can understand that it's not easy to just pick up a naked chart and become a master of price. It can take a while. So there's little things you can do with moving averages. Is remember first slide, if you've got the you've got moving averages moving lower, you've got lower, 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 high. Now in this period of time, what's actually happening as well is not only is it beneath both moving averages, which shows that momentum is bearish on 2 time frames, but it's also moving away from the moving average, so it's getting faster. So again, you know straight away that if you're going to be using overbought, oversold, it's going to be less probable because you've got 3 signals here telling you that the stochastic has to be down here. It's telling you that it's beneath moving averages, you've got lower, 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 high, and you're moving away from the moving averages. You are quicker than those averages. You're accelerating that downside, so that has to stay down there. If you're looking at considering reversal, you could maybe look until it's broken to the upside, but until you've broken a prior swing low, then for me, you couldn't really confirm it's a trading trend. This entire time, what's happened is you're actually moving sideways. This starts moving around. Over time, we're now going to find out if that broke up at the moving averages and developed into a trend, or whether it just rolled over again, and there you go. RSI, it's the same principles, but it's the same but different. So again, which we won't dwell too long on these, we'll bring up some live charts and stuff. But let's cover divergences. They're very popular. I love divergences, but again, people generally, I've found, like to go against the grain. They like to go against the trend, hoping that if they can just get a divergence and they go against that movement, it's going to be the trade of a lifetime. And I've honestly found that people who will tend to jump into a trade keenly, look for a turning point, even if they manage to nail that turning point, they find it very difficult to hold onto the trade anyway. So they're in quick, they're out quick. On this divergence, for those who aren't aware, you're comparing what's happening to price. It's going higher, high, higher, low. So we come up, we look up, we use the trend analysis. This is bullish, high, high, higher, low. At the same time, we notice we've got a divergence, and prices does in fact roll over. If you, again, I'll cover this in depth in a separate webinar, but if you're going to go down the trading reversals and divergences, you've got to use multi-time frame analysis, and it can take a long time for prices to reverse. Look at how long, here is the signal. This is back in March. It took until May for a new trend to actually break beneath these lows. That's a long time being wrong on the daily time. That could be a 1-minute time frame. So if you're doing counter trend trading or fading, generally speaking, you might want to use a lower reward to risk ratio, because you've got to expect you're going to be wrong more often. Those who have tried this will probably understand what I'm on about, but some people just want to do that all the time, that they don't want to stick with that trend. Now, when you get to 30, traditionally it's oversold and 70 overbought, but again, same thing's happening here. When you move down, it comes down to sold. This doesn't show an example. That can stay there for a considerable amount of time, and price can keep on going down. And if you see that, you probably want to be not necessarily entering short on that time frame. You probably want to go to a lower time frame and look for bearish opportunities on that. So let's pull up some live charts and just see what we can find. Going more into the RSI, actually, I've jazzed this one up a bit. So you've got 70, 80, 50, 30 and 20. If it's above 50, it's assumed that it's a bullish, not bias, but the momentum over your chosen period, which is 5 in this case, is positive momentum and negative. The reason why I've used these levels is because, is this the best chart? Yeah, okay, we can do this. Classic trend analysis, lower low, lower high, classic trend. Again, you're seeing periods here where it keeps on going to that supposed oversold, but it keeps on breaking lower. Thing to note here is when it's in a established downtrend, notice how the upside on the RSI doesn't even get anywhere near 70. So we're looking at maybe this period of time here. So what you could do is if you use RSI, make the assumption if you're in a bearish trend, you lower the overbought oversold levels. So in this case, we're saying that what was 30 now becomes 20. So there's our oversold range, and it does dip there a few times, but it's probably not going to go above 70, which is also what happened there. So you literally just change it. So there's a bearish move, and we move the lines down. And the same if you're in a bullish move, although it doesn't work. I think this probably, dollar CAD's probably not the best chart to use for this. Maybe dollar yen would be a better one. And that's another point as well. You will find that when you use, maybe we'll try to specialize one indicator, different markets will have different characteristics in price, which means you're going to have that same issue on the indicators as well. Side example is cable is one of the best markets I've seen that reacts to 50% Fibonacci. I don't know why. There is crosses don't tend to so well. So where's that? Here it is. We need to increase the length here. So the mistake I've made there is this on 5 still needs to be on 14. 14 is the off-the-shelf setting. Yep. Actually, the other thing you can do with the momentum as well is you can do trend analysis on it to confirm. So in this one, you've seen dollar yen, for example, has been going down. You can even do so if we draw this as a flag on the chart, you can even go down and do similar things on the momentum, because you're basically using confirmation. So if you had a breakout the downside of a flag or something, and then for whatever reason it didn't happen on momentum, it's not a magic signal, it's an assumption that it's broken out with less momentum, so you'd be a bit cautious or wary of it, so you might want to wait for more confirmation of what's actually happening. Again, you need to really like charting to be able to go to that level, I guess, especially if you're starting out, but you can even do head and shoulders or etc. patterns. But really you're looking for momentum back up price. If in a trend you want to see momentum backing it up, before that trend turns you need to see that divergence is forming, and then before reversal occurs you need to see price breaking the trend before you start really paying attention to those what's happening on the momentum in terms of the overbought oversold levels. Let me know if there's any questions along the way as well. So no, probably going a bit fast for some perhaps, or too slow for others. Bollinger Bands, these are... Oh, sorry, I missed a question. I do apologise. Irene, why is there a no centre line in the... I'm trying to think what that is. You could repeat the question, please? I think you've... Oh, sorry, yeah. Dochi and Bar. I don't know if I have that on me, actually. We will go on to that at the end, if there's time. But that's a good one for using breakouts. It's an overlay, so we'll get onto overlays now in terms of Bollinger Bands. So Bollinger Bands is very different to the is it Dochi and Bar, I think it's called, or Dochi and Bar, depends on how you pronounce it. There's actually two things happening here. You've got a moving average, and then you've got standard deviation, which is if you've got two standard deviations, it assumes around 98% of the action falls within those bands. If you use one standard deviation, it would be a narrower narrower bands, and I think it's around 68% of price falls in, and it's very, very popular. It can be used in trending and non-trending markets. And again, like a momentum oscillator, if you've got sideways price action, it's pretty good at using overall oversold levels. So here you might have had, for example, a couple of bullish hammers, oscillates around. Now at this moment in time, you'd have been in a bearish trend, so you wouldn't have known. But at this point, you can say that's a sideways market because it's not really in a trend, in which case you could start using these as overall oversold levels to trade in a ranging market. Conversely, if we agree that this is the downtrend here, you can use it to counter trend trade. So you go against the trend. Of course, like I said before, if you're doing that, my personal approach, if you're doing counter trend trading, you want to use smaller positions ideally, or go for less reward to risk ratio, because it can, if you're in a particularly strong trend, in theory there's less chance of that reversing. At the same time, it can be used as targets. So I've actually done a separate webinar on this, but if you we'll be doing, I think, mean reversion strategies. You can actually start layering together multiple Bollinger bands. One could be used for stop placement, one could be used for profit objectives. So assuming you tend to like a higher reward to risk ratio, you'd use the wider bands for your profit objectives and the narrower bands for your stop loss, and you're looking to get those moves. Of course, here's a good example of, like anything fails in an indicator land, is even though this is moving sideways here, if you're doing strategies which is buying at the lows, selling at the highs, and trading the range, at any moment that can go into the mother of all bullish trends. And here, if you were to just blindly fade every single time you had a close or a high, even outside movement outside of the upper band, it can just keep on going. So in that case, if we agree that this is now in a trend and it's broken to new highs, you might want to switch indicators. So you might want to get the moving averages out and not be using this. It's all about the trend essentially. So this sort of same like using dual Bollinger bands. And is that the, let's try and find a more suitable chart. So you can have a bit of a play around. So for example, in this case, prices moved up, and you can see that whilst it's not forecast that's going to happen, at this stage, if we now agree going lower, high, low, so high, low, high, low, when you actually break out of this one and you start to move above the one standard deviation, in actual fact, that's a pretty good strategy. You'll just, as long as you keep on the lows of the candles are above the one standard deviation, you're assuming that the near-term trend is going to remain. I mean, that's a mechanical way of maybe doing it. If you analysis, you might go to different time frames and so forth. The same thing happens here. You might use it, for example, as a close outside the lower Bollinger Band. You've got a lower low, lower high, you break the price swing low, and you close beneath the outer Bollinger Band. That's not a reason to suspect, in my view, that it's oversold. You've just had a fantastic breakout, and it's exceeded the bearishness of all the indicators preceding it. And what you could then do is revert to the strategy where you think, well, every close, you go outside the Bollinger Band, you could maybe trail the stop, for example, down the one standard deviation. And second you get back within or close above, on this example, it's quite nasty, it would have wiped out potentially quite a lot of profits. But then that's your reversal signal. You can get some pretty good long trends from doing that. Yeah, I'm actually in MT4, so I'm not sure if it comes as standard. I would have to download it. No, it doesn't come as standard. I'm pretty sure you have to download it, unfortunately. I do apologise for that. But for those who aren't aware, they basically put these straight bars above and below price to use a certain setting, and if you had a setting of 20, it would show you the line would go across the highest level of 20, so of 20 bars, and it's good for box trading or if you're looking at new, but it's a bit hard to really go through if I don't have it in front of me, so I do apologise, I can't do that one today. But perhaps what I could do is a separate video and maybe get that on the education session if that makes up for it. One I would like to cover is pivot points, because they're extremely popular, especially amongst day traders and forex traders, and there's a few caveats I would say. Firstly, they look great when they work, and what they try to do is these dotted lines here, that's just showing the 24-hour period, and what it's basically doing is it's taking the open high low close price of the 24-hour period and then putting it through its calculations and then projecting this session's support and resistance levels. So you get the central line, which is the pivot point, which I think is the average of the high-low close of the prior session. And then it's got deviations of those, so you've got resistance 1, 2, 3, sometimes more. And you can see on this particular example, it worked pretty well. You would think, great, I'm going to buy it. Every time it goes near this level, I'm going to buy. Every time it goes near, I'll sell. And then another way of using it is if it crosses over, you assume it goes through the next level. And it does look fantastic, but the thing you should consider is if you're using the traditional daily pivot points, it's using yesterday's price action. Well, different people around the world, different time zones use different closing prices. So you'll find I use the New York close. That's what the ThinkMarkets MT4 uses. So if I can hand these around, but these are, I use pivot points. So this is using the New York close, which is on that dotted line. If you were to, I think 5 hours earlier is the UK close. So if you were to shift these lines back 5 hours, you would have a different open high-low close for the session, and that would predict different pivot points. So that's something to be aware of if you are using pivot points for day trading specifically. But you can also see that on mine I'm using the monthly and the weekly as well. And like I would say any form of analysis, you tend to get more reliable signals the higher the time frame you are. And if you're using pivot points, they were just blindly using one set, I would say, yes, it's great, but it doesn't always work. Use 2, 3, I can send these around at the end, but I've got here weekly R1, which means the weekly resistance one, and you've got the monthly S1 with monthly S1. So if I draw a box here, I find it so frequently when you start mixing these boxes together, they do in fact act as much more reliable levels of support and resistance, and it's very, very low effort from you. Here you've got the weekly pivot and the monthly S2, and if you were to start mixing those with prior swing lows, you just start boxing off, you'll be amazed at how many times you see reversals and profit takes from these. Obviously, the wider the box, less people might notice it, but when you see these really thin ones, they really are excellent, in my opinion, for profit objectives or potential reversals. And these are good to know if you're day trading as well. So again, they can fail pretty miserably. So you've got a bullish break there. If you just purposely bought for the breakout, it reversed. And for whatever reason, on this session, they just weren't that reliable. Some they are. You never know in advance how low they're going to be. The other thing to keep in mind is if you've got, for example, let's say 5 days of very, very low volatility, that means it's using the prior session range. You're going to get very low volatility SR levels on this session, and you might have a huge event like NFP coming up, in which case it's going to blow past all of those levels. And the converse, if you've got an extremely volatile session, then you'll find that you've got very, very, very wide pivot points to the SR levels, and that they're less reliable. You're very unlikely, from my experience, to be getting anywhere near the third or the second one if you had an extremely volatile session. So just common sense. So indicators indicate they're not magic. The main thing I wanted you to take from this is it's pretty much everything is trend analysis. If you can't identify a trend, you're going to find it harder to choose the correct tool. We can go through indicators now if you've got any specific ones to look at that I've got. Or any charts you'd like me to just quickly go through and do some analysis on. Then we can, I can show you how I break down that, which indicators I'd use. So let me pull up some charts. So we're in, what time is it now? 9 a.m. So UK session is well and truly off. Let me find the so on this one, we had a pretty epic move down. We know that this is technically in a downtrend. You've got lower low, lower high. You've got the RSI hit 30. That doesn't mean you've got a long-term reversal. It just means for over that 14 period of time, mathematically it got down to 28. We can very easily roll over again, and it would bring down the RSI. But what would happen is if we were to get a movement like this, and I was saying that actually you can tell divergences on price, you don't need the indicator. If we were to spend this many sessions, say 14 sessions traveling this way, there's no way the RSI can break the price swing low, so then you'd have a bullish divergence. And what if you hit Control F on MT4 and measure, so we know that we travel 355 pips in 7 sessions, whereas here I'm saying 200 pips in 13 or 14 sessions. It's price and time. You've traveled half the distance in twice the time, therefore momentum is not there, therefore it's not going to go down as much. And again, that's not a reason to just start buying the market on it alone. You might have other reasons, like you've got this classic support down here, you've got the monthly S3 down here as well, so perhaps there's an argument to be said that I would say that if we were to break beneath this pretty low and come towards this monthly S3 before the end of the month, over the next week, then it's a pretty obvious level for traders to be booking profits as well. So I'm not expecting a huge downside break in Kiwi dollar just yet. And again, you're just doing beta analysis to try and work out what's going on. You've broken that bullish channel, but over this period of time, you're not really in a trend either. So it depends on which time frame you're looking at. If we then go down to the lower time frame, you can see again you've got this really tight range on the weekly and the monthly. So you've got weekly R1 here, you've got the monthly S1, and again, it's the amount of times I see it, it's amazing. I don't see it that often when I look at the people's charts that use multiple pivot points. It's the easiest, laziest guide to hitting potential reversals or stalling points at least. And you can see, as you would expect, using price and time, price is pushing higher highs, yet because each time it goes up, it's traveling less distance, you've got a divergence. Because we've agreed, for argument's sake, that the higher time frame is in a bearish trend, we're looking for reasons. This is when I start fading against this trend, because I think I've got my resistance levels here. It's running out of momentum. The high time frames is probably going to take another dip lower. So Kiwi dollar, I'd like the opportunity for a short position on. Then it's down to how you want to approach that entrance. So is there any particular markets or indicators you want me to pick up from the MT4 list we can cover through? Let's see what's happening on the gold market. And the same Fibonacci, let's cover a bit of Fibonacci. Technically an indicator. It's one that goes over the charts, of course. And again, like the pivot points, I'd never use one Fibonacci on its own. If you're in a bullish move, so this part is bullish, if it's a strong bullish move, then you would expect shallower pullbacks, in which case You wouldn't expect price to crush between 38.2. Again, it perfectly tested the 50%. So the fact that it went through the 38.2 and to the 50 with relative ease suggests that maybe if it does go higher, perhaps the next leg up is not going to be that impressive. If we've got a day and a half of selling and it stalled here and then went up, that's a lot more momentum behind it. But again, you're going to get more probable potential stalling points if you have multiple Fibonacci levels around it. So in this instance, we tested the 50. It also coincides with the price swing high, although it has been breached, it's still valid. So there's a good zone around these levels. If we go to the current time frame, notice how you've actually got shallow pullbacks here. So whilst we are approaching these highs, notice the shallow pullbacks. What we can then do is you're making the assumption that we've seen a top just here. So you go from the price swing to this high here. And we could, for example, say the 38.2 rests around the monthly R1. So we may say that we are bullish, but don't like buying just beneath the highs. So we could say if we get prices moving down towards the 1242 area and it stalls, we could either wait for a bullish signal, we could make the assumption it's going to turn around, depends how you want to trade it in your strategy, but it's a classic buy the dip approach, and Fibonacci and pivot points together along the swing highs makes some pretty good, pretty easy analysis to do, and respecting quite, in this one you've got the monthly pivot. At the time you can see it crashed through, acted as support, bounced through, bounced back up. So if you're day traders, by all means use the monthly and the weekly pivots. And if you're using moving averages, at the moment, just notice it's stalled on the 200. But if you've got this movement here and it's accelerating away from not just the 8, but it's got several moving averages and it's moving faster than any of them can catch up, then it's not really going to favour selling because you're in the overbought level. And that's a condition where I think you can probably delete most indicators and just use moving averages and use pure price. It's probably the easier condition. And if you've got prices accelerating from moving averages, then you go down to the lower time frames, and again you've got 2 time frames that show the same thing. And this is where you would then maybe bring out the pivot points, the Fibonacci, testing how deep are those retracements, and maybe come at that with candlesticks. And I'd argue that actually less is more. Get to master a few. There's the MACD, which is the trending oscillator, as they call it. But again, I'd say 95% of indicators have a moving average base in it somewhere. So when they claim to be predictive, they're not really, because they're using an average of historic price data to make an assumption of the future. It's not a prediction, it's an assumption. So it doesn't look like I've actually got any questions or requests. So last chance, whilst we see if that is the case, just to let you guys know that there's there'll be more webinars coming up soon. So chart pattern trading I'll be doing next week, and I think these should all be revised again. That'll be me taking a multi-time frame approach, or looking at simple patterns that are easier to identify, how to identify them without getting too bogged down in the details and the book, so forth. Check out the Twitter feed if you need to keep regular market updates there. We've also got the YouTube channel, so if you sign up to that you'll get notification every time we do analysis. And we do requests as well, so if there's any particular analysis you like us to see and it's suitable, we're not going to do day trading signals, because by the time we get it posted and sent out, it's not probably valid as such. But if you come to this site, here, this is where all the analysis goes, videos and whatnot. And it's a combination of fundamental and technical, depends on what's really happening at the time. So you can see, and it's a good way of learning as well if you're starting out. I mean, that's how I started, was looking at what other people were doing, taking the bits I liked, ignoring the stuff I don't. So there's videos, it's a good educational source as well as analytical. So I hope it's been useful. Please do sign up for future webinars. Let us know any feedback or request for topics to support@thinkmarkets.com. And any questions you forgot, send an email there as well. And I hope to see you next week and wish you all a fantastic week's trading, or a weekend, I guess, if we don't see you then. So thanks a lot, guys, and hopefully see you all soon.